Yeah.
Hey there, it is Corey here, founder and financial advisor at Verse. I hope you have enjoyed a wonderful week. It's certainly been a busy week here at the remote Verse HQ. As most of you know, we've been in touch in recent times trying to get a lot of money into super pre-30 June to reduce your tax and boost your super. And it is a very busy time of year for us financial advisors. We're coming back to you again with another market and economic update, and I am joined again by one of the financial advisors in our team here, Ashley Bishop. Ash, thanks for joining us. How have you been in recent times?
Keeping well, thanks, Corey. You are right. It's a busy time for financial advisors and all of us who have 30 June as an important date for the end of the financial year. But no, keeping well otherwise. And still working from home. One day we'll see each other in person, mate. But until then, the Zoom sessions will have to suffice.
Well said. Well, I do know we are catching up for lunch and watching our two footy teams go at it in a couple of weeks' time. So go Saints. Now, in terms of today and what we've got in store for you, so I'm going to give you in a moment just a quick update as to what's been happening from like a market and economic perspective in the last 3 to 4 weeks since we last kind of jumped on the airwaves for you. We have been saying for a while that expect the resumption of volatility in financial markets at some point. We have seen that resumption in the last couple of weeks. And volatility is such a topical and important concept when it comes to markets and investing. We want to dig into that topic today. Ash is going to talk a bit more about like what is volatility, how do we know we're in volatile markets, how can we react and respond to it, and how does the media influence our perception of volatility as well. So that's coming. That's going to be educational and valuable for you and improve your investment behavior moving forward. But as I said, in terms of, I guess, what's been happening in the last 3 to 4 weeks, we have seen some big swings on investment markets. So taking the Australian market as an example, just the last 30 days, we saw markets up about 13%, and then we saw markets come off about 10% in the last week. Since Monday, they've regained about another 5%. So we're seeing these big swings in the short term. And we're seeing that in global markets as well. We did see those recent falls in the last couple of weeks, in part on the back of some of the comments from the chair of the US Federal Reserve, Jerome Powell. That's their version of the Reserve Bank of Australia. And he basically said, in short, that the US is in a tough economic spot and it's going to be a slow and sluggish recovery, which is we're familiar with that already. But markets had bounced really aggressively off their March 23 lows. They're up about 40-45% in the US. So markets were really due for a pullback and probably looking for any kind of news they could find to, I guess, initiate a bit of a pullback. So that volatility in that pullback is healthy, and that's commonplace within markets as well, despite how it might be reported in the headlines in the news. So back home, we know that yesterday the new unemployment figures for March came out. Unemployment has risen to just over 7%. We had a pretty big jump in May. We had about 600,000 Aussies lose their job, and we had a bunch more in April lose their job again, which isn't great, but it has been expected. So hopefully those numbers begin to tail off from here. Now, that's what's been happening. We're not going to spend too much time there. We are going to dig into the concept of volatility. As I said before, I've got a few questions lined up for Ash. Ash, the first question for you is, we hear this term volatility. What is volatility, and how do we know when we're in a volatile market?
Thanks, Corey. Look, I mean, right now we are in a volatile market, and the reason we know that is because volatility measures really the difference in price swings that we see from one day to the next, or potentially week to the next. But ultimately, at the moment, we're seeing really volatile daily swings on occasion. Now, if you see here, we've got the all ordinaries for this week. You can see early in the week, we saw a real dip in the market on one day of 3%. So the market lost 3% in Australia in one day. Now, volatility, if you're over 1%, realistically, that's sort of the benchmark measure of low volatilities. If you're around that in a day, so say, for instance, today, Friday, we were up at one point around 1%. We've pulled back a bit since then. But if you think of 3% in one day, given that 1% is your benchmark, that is really, really significant. And really, in terms of history, is pretty unusual. And that's why we're talking about we're in a really volatile market, because we have these big daily swings that you wouldn't traditionally expect to see over the course of market history. The flip side of that is that the next day during this week, we saw a 4% increase. So if you think about that, I mean, you have this unusually high loss in one day, followed in literally the next day by an unusually high gain in one day. So we have talked a lot about how often the biggest gains follow the biggest losses, but we've talked about that in terms of year on year, sort of the GFC in 2008, followed by 2009 being one of the best years in market history. But we're starting to see that on sort of a daily basis as well. So when we talk about volatility, it's really sort of creates uncertainty, creates fear. People wonder what's happening because it's just not normal, and people like their investments to hopefully steadily do well. And if I share another screen in a moment, you'll sort of see what I mean. If we go back and look at, so that was the 5-day, so that was the last 5 days in the All Ords, which is the top 500 companies in Australia. If we look at that here over the last month or so, you can see that that volatility really smooths out, but there are still some really big swings on almost like on a weekly basis there. So volatility can be daily, but it can also be volatile over a month or a year. And that's really what we're looking at this stage, is really big swings over a period of time. But if we look at this market and on the month market, you can see that it's still steadily tracking up, at least on this month. Now, obviously, that won't be the case in every time, but if we'll look at some other charts a little bit later, but you can see that even though we do have a lot of volatility, it doesn't mean that markets are necessarily going down over the long term. But we just want, if we talk about behavior and what we should be doing, Corey, and I know we'll come on to that again in a moment, we just want to be just being calm, understanding the volatility happens. We're in a really unusual time. Like it's, I think 100 years ago, we had the last global pandemic. So we are going to see more volatility, but we've just got to understand that it is going to happen, but we want to let our strategies and our investments just continue to do what they do over the long term.
Yeah, really well said. And I think you probably segued to my second question for you, which is specifically around, how should volatility, influence or affect people's investment behaviors? And you're really talking about, staying focused on the long term. And markets are rising long term, but can be volatile in the short term. I know that you've got a chart in particular to kind of illustrate that from a long term perspective. You've put up here the volatility index. So just explain what this is for us, and I know you're going to maybe give us some really long-term historical context for volatile markets versus long-term investment returns.
Yeah, absolutely. So yeah, you are right. I've pulled up what's commonly known as the volatility index. It's out of America, actually out of Chicago. So it's not directly related to the Australian market, but importantly, like we've talked about, the Australian and the US markets are highly correlated, meaning they are very similar in many ways. So we can and do use this index as a measure of volatility in the current markets here and abroad. Importantly, if we go back to the sort of halfway down, you can see in 2009, we had historic volatility. And so this is really just a measure of how investors feel about the market at that time. So normally, in a normal sense, you sort of track around that 20-point basis. But during the GFC, when the world economy almost collapsed, we saw really high volatility, so wild swings one way or the other in global investment markets, and company-specific, market-specific. Just for those of us who were around and investing and remember that time, it was incredibly unnerving and quite frankly scary time to be alive, be in the market, be invested, especially around the world. So that reflects that high volatility in that time. As you can see, since the GFC, volatility has decreased. So people have become more confident, economies have grown stronger, people have felt better about investing, and volatility historically has been maybe even a touch below in terms of where it usually is. So it reflects that there's confidence in the market. And of course, then we get to the end of that chart there in 2020, As we're all aware, the coronavirus COVID-19 pandemic swept worldwide. And once again, volatility really jumped up because, again, people didn't know what was happening. It was scary. There was a lot of fear. And we saw that in reflections in March and early April, where the markets really tumbled, as we talked about, that 35% falls from their highs. And that reflected the volatility there because prices were just moving incredibly quickly, which is, again, unusual. And if we think about this chart, we're talking about the GFC, one of the biggest downturns in human history, and now a global pandemic, which is also causing a significant downturn, the depth of which we're still probably trying to understand at this point. Now, you asked the question then, Corey, about how should this affect our behavior? And as hard and as sort of unusual as it is to say, realistically, it shouldn't affect our behavior all that much. Naturally, people are going to feel that fear because that's what that volatility index is measuring. It's measuring fear, it's measuring uncertainty. But if we think back to this chart, and we've showed you this chart a few times in the past, but it is a fantastic one. And the lessons from it remain true in these really volatile periods, is that even though we don't have the coronavirus pandemic in this chart yet, historically we see that these bear markets where we see more than 20% drops off the highs that we did back in March, that's where the bear market came in, which we talked about previously. They tend to be relatively short in terms of economic history. They may not feel short at the time because, these are real lives that are having impacts and consequences on. But ultimately, if we look at the GFC being the most recent, about 1.3, say 1.5 years there, that we saw downturns in markets. But over the period since then, we've seen slow but steady recovery. So even though you have high volatility, realistically, we know that markets, once that volatility subsides, will continue to work, will continue to function. You've got good companies and good assets that are continuing to try and work and make profit and do well and grow the company. We will see recovery if that's allowed to continue, which means for our strategies, if we are invested in good assets, which if you're a client of Versa Wealth, you certainly will be, then even though it is counterintuitive, we just want to stay calm. We want to trust our strategy, have the phone calls that we need to have with your advisor because they're always available. But ultimately, we know that historically that recovery will eventually happen, that volatility, based on the previous graph we showed, that will come down, and we'll just continue to invest for the long term like we have been all along.
Well said, Ash. I'll just get you to scroll up a little bit on that slide. One thing that's important to note is that when we have these significant corrections or market crashes, and a crash doesn't happen all that often, as you can see over this 40-year time span, is that markets don't stay in that state for too long, right? Like we can see in the GFC there that markets were really grinding lower for a little more than 12 months, which felt like a very long period of time for investors and superannuants at that point in time. But in the grand scheme of things, with some longer term context, it isn't long in reality when we're all investing for the long term. So we tend to get to the lows of market downturns pretty quickly. And those lows present value for investors, and we tend to bounce off the bottom initially before we tend to move into a longer term rising market that has its ups and downs along the way, but we don't necessarily revisit a market crash for an extended period of time. So I think it's a great chart to illustrate that particular point, Ash.
Yeah, and one thing I will say, Corey, because this is going to be relevant over the next weeks, months, and maybe years, depending on how deep this downturn goes, is that the market is not going to just go up in a steady fashion, in a linear fashion. You can see here on this chart, there are going to be dips. It's not going to be a smooth ride necessarily, but as long as we've got good investments, we're confident in our strategy, and we know that we can talk to our advisor if they need to, over time, the strategies will work out because these companies, these good assets we're invested in, as long as they continue to operate, which they generally will, it'll be fine, but it's just there is going to be volatility now. We're in historic times. There's going to be historic volatility, but over time, even through all those bumps and dips in the road, as you talked about, Corey, if we let it happen, then we'll be okay.
Well said, Ash. Last question for you here, and it's a really important one. It is around the media. So we know that financial markets tend not to be too prominent in the news unless we have periods of high volatility. And when we do, we see some pretty scary headlines out there as well. So I know you've got a bunch of headlines that you're going to share that you've pulled from the news in recent times.
I do.
Just tell us a little bit about, from your perspective, the influence that the media has on people's perception and feelings towards market volatility.
Well, I mean, put it this way, Cora, if you wake up in the morning and you're like me and you grab your phone and check the news, if you open up your news app or search and you see economic shockwave, Aussie bank bloodbath, as stock plunged sharply, those are emotive words. They are designed to get you to click the link, but importantly, they are going to impact how you think. We have some others here, which I will also share in just a moment.
That was I think it was Monday this week, might have been Tuesday. Markets, I clicked on that article, markets were down 2.3% for the day.
Yeah.
So I'm not sure where the technical point is for bloodbath.
Yeah.
But I thought it would have been more extreme than that. But that's also on the back of our market being up 35% in the last 10 weeks. So you've got to put it into perspective. There's certainly some
that same day, Corey, Westpac was smashed and they went down 6%. But my understanding of smashed is that is something that's beyond repair. Westpac down 6%. They're still doing pretty good. There's still plenty of money floating around there. So, I mean, we've got this one here. This is always talking about retirees as with all due respect and apologies in advance to the retired members who are watching this video, are easy targets for news headlines because they, it's an emotional topic. Everyone wants to retire comfortably and feel sort of good about their finances. So news outlets love to talk about retirees as well because also they tend to be the ones buying the papers more than maybe the younger cohort as well. So retirees face financial ruin. This was one back in March. Of course, where we are now, look again, we talked about volatility. It might not be the same tomorrow, but realistically, most people have recovered if they continue to hold their positions, and they're probably back to where they were. So they're not really in ruin at all.
Yeah.
I'll share one more with you just because we were joking about this earlier.
And just on that one too, because we've got plenty of retiree clients here at Verse. None of them have faced financial ruin. They're all okay and fine and enjoying life. And none of them are fully exposed to the share market anyway. They got diversified portfolios with cash and bonds and deposits in there as well. So when markets fall 20%, their portfolios fall nowhere near that, and they're back where they were.
Exactly, Corey. And many of those clients are yours, so well done to you because they've obviously got some pretty good financial advice in the past to have that diversified portfolio. The one I was talking about just before, because Corey and I were joking about this, look, we will be fair to the person who wrote this headline because this was from March, but the Australian share market falls to fresh, horrific depths as coronavirus fears escalate. The definition of horrific in terms of market downturns, I'm unsure of. But again, we're just talking about this really negative, emotive language, which is going to impact how you think because the media, depending on how you feel about the media, one way or another, they inform us. They inform how we think. They inform how we feel. The language is important. So when you are reading these headlines, definitely read the article, but try and put it into perspective because, as you talked about, Corey, down sort of 3%, or even Westpac being down 6%. The company's still operating. The market is still operating. There'll be good news down the track. You may not hear about it, but you'll probably find that there'll be a recovery in time as well.
Really well said, Ash. I'll get you to stop sharing your screen if you can.
Absolutely.
Thank you. And I'm glad we're finally sharing some of those headlines as well. because as you said really well, they influence how people feel and how they think and their perceptions of their investments or their superannuation. And the reality is that as human beings, we're emotional creatures and we all make emotional decisions, even the most pragmatic amongst us. So the headlines matter, what we consume matters as well. And this is why having a base level of knowledge, having the right people around you, and having really well set expectations is so crucial to making sure you do well from whatever investments you have in the short, medium, and long term as well. And I think you'll recognize if you're a client listening to this, these are really the premise of so many of the conversations we have with you around the investments that you do have. So we are going to wrap up there. Everyone has a weekend to enjoy. The footy is back. I'm looking forward to another Saints victory this week over the Pies, hopefully. And Ash, I hope you have a wonderful weekend. Thanks for the education today around volatility. And to all of our clients out there, if we don't talk with you between now and 30 June, have a wonderful, happy end of financial year. It's an unusual one. We did send out a video last week with Andrew from One Ledger with a whole bunch of tax tips for individuals, but also business owners as well. So if you haven't checked that out, feel free to jump in your inbox and watch those short videos. But aside from that, enjoy the weekend. Hopefully you're doing something that you really enjoy that lights you up, and we will talk with you very soon. Take care and bye for now.
Thanks, everyone. Bye-bye.